recently we had an episode where the market sort of freaked out about the Trump tariffs and potential retaliation, what that might do. And unusually, the bond yields actually rose because there was a kind of a run on selling, and and it got people, and the dollar fell, and it was like, this is an unusual reaction. Why aren't people not reacting as usual to this flight to safety? And it raised the question about whether or not the U.S. was losing some of its shine as a safe haven. Is that like maybe a temporary blip, or is that something we should be concerned about?
I think it's something we should be very concerned about. And we should also ask precisely why are we losing our shine as a safe haven? Is it because we think there's now default risk that's been introduced into treasuries? Is it more of a politically strategic move where foreign central banks are selling off as far as retribution for these reciprocal tariffs? Is it just in general, investors see better opportunities elsewhere? What precisely is driving the decreased demand for foreign investors purchasing treasuries? I think it's really important that we understand that. We haven't quite figured out what happened when we saw that massive overnight increase in treasury yields. It seems like it was a combination of some selling by foreign investors coupled with US hedge funds, which were very leveraged in terms of the treasuries they purchased and needing to sell those quickly. But regardless, we saw precisely what can happen when investors quickly lose some appetite in treasuries. I mean, this was not like a wholesale sell-off. This was a pretty moderate decline. Investors were already a little jumpy because there had been an auction a couple days earlier where there wasn't particularly strong demand to buy newly issued treasury securities. So I think the groundwork was already laid for some trepidation. But I talk to people in markets and they just think there's almost no chance of the 10-year being over 5%. Again, remember it's about 4.2% today. I'm not saying it's going to be over 5%. I'm not giving investment advice, but if you think there's no chance, I think that that's crazy. We saw it go up by 50 basis points by 0.5% in just a few short days. And if you got a situation where you saw the administration take a position like the one we saw the chair of the Council of Economic Advisors advocate for, where they say, look, we want to introduce a haircut on foreign investors who own treasuries. I mean, 50 basis point jump will feel, like a soft tap. And so I think things could get much worse. Look, I'm wrong about a lot of things. One thing that I was right about was I've been saying with this administration, courts matter less, markets matter more. So this administration has obviously pushed the envelope when it comes to legal decisions. It levied unprecedented tariffs under questionable legal backing through IEEPA, but markets still matter. And I think what you saw is a president who was okay seeing stock prices decline by 10 or 15%, but was really scared when you saw the bond market start to freak out. And so I think right now some of the most powerful forces shaping the administration's policy are financial markets because they are playing the role of referee.
And of course, to tie it back to the budget is very vulnerable to a spike in interest rates because what it does to interest costs, which are already pretty high. I mean, back when you were talking about that 25 years ago, I agree that I remember when the deficits were coming back in the Bush administration, and then interest costs did not go up. I can remember thinking, how can that be? And so we went along for that for a long time, and then interest rates went up again, and all of a sudden last year, interest was the second largest expense after Social Security. I mean, how vulnerable are we to interest rates?
So we have some calculations in the paper where we show the impact of inflation on different debt trajectories, and we discuss the impact of higher interest rates. I mean, it sort of depends on the magnitude of the interest rate shock, but because we have such a large stock of debt, because we have this $30 trillion stock of outstanding treasuries, we're increasingly vulnerable to higher interest rates because we're paying more and more interest relative to the size of the economy. So if you saw interest rates go up by a few percentage points, that just, those projections of 166% debt to GDP ratio 30 years out suddenly become much, much closer. So they obviously exacerbate the problem because we have such just a massive share of stock of debt.